Hi everyone, Adrian here. In this video we're going to be focusing on the concept of buffers. Alright, we're going to be looking at this from an investment property buyer's point of view, and I'm just going to bring up my LinkedIn post here. You can see some of the topics that we're going to discuss, and we're just going to go through them one by one. I'll give you real life examples of what I've gone through, how I've managed things, and I hope this video adds a lot of value to you. I am a mortgage broker based in Brisbane at the moment, and if you need help and you're a property investor, feel free to reach out. You can book an appointment straight in my calendar below. So let's go straight into the content. Alright, so we're talking about buffers, and let's talk about borrowing power. And it always comes back to what your perceived goals are and where you want to be in the timeline that you want to get there. So I'll give you an example. There's a lot of households in this country that can get to 3 to 5 investment properties without going too crazy on the borrowing power side. So these are 3, 4 and 500k properties that they buy. And, there's a lot of different ways to skin a cat. They could be buying units, they could be buying townhouses, they could be buying just main houses. They don't really need the really high yield or rental stuff to get to those borrowing powers. And we're talking about those typical households of, 2 to 300k income. Okay? When we're looking at those kind of incomes, on your buffer side, when you're only going for 3 to 5 properties, you can be a lot freer with the property strategy that you use, as well as the buffers that you have in place. Because in reality, you could do 5 properties very quickly, or string them out, once a year if you want to go a little bit slower. And regardless, you're not taking on a much larger portfolio, right? So, some people, if they're going down the negative gearing route, you probably need to have larger buffers. All right, that's just plain and simple. So I'll give you an example. Let's say you're buying a house out in Penrith or something like that, which is Western Sydney. You're buying it for 900 grand and it rents for 600. You're going to be negative cash flow, let's say 15 grand a year. For you to carry that and hold that, plus have 4 other assets, you're probably going to need minimum 100 to 150 grand cash buffer. Because if you don't, you're in a situation where the properties are negative and there's a lot of money coming out of your account, and you can't cover yourself until you get to the next tax return. So a lot of the time when we're talking about buffers, on the borrowing power, it tells you the key figure that you can get to, right? But it doesn't tell you the progression plan that you've got to go in to get there, and how gradually you've got to have a larger and larger cash balance to account for, shortfalls on properties, maintenance, vacancy, 5 to 10 grand in each offset account, things like that, to make sure that you're stable and you can keep the properties long term. All right, then we talk about borrowing power. So there's this other type of client that even if they're on household incomes of, say, 150, or they're a single person on 100, you're going to be protecting your borrowing power a lot more than people on the much larger incomes, okay? Because they can buy a couple of properties or cabs off the rank and still have excess to keep on buying even when rates are high. If you've got a lot of kids, or you've just gotten married and you want 1 or 2 kids in the next couple of years, then you're going to be protecting your borrowing power a lot more than others. Okay, so we always talk about these concepts when we're talking about, do you own the properties in your own name, or do you rotate one property in one name, one in another to manage land tax, or to manage, who's on what tax rate, because you can distribute the rent to the person that owns the property. Okay, so that's what some people do to manage. And we're talking really about the difference between those simple structures and the more complex structures using trusts and accountants. All right, so when you're in a position where it's much tighter and you want to make sure that you're future-proofing your borrowing power, those ones on the lower income, or those ones that know that they might be having a change in job, or those ones that know that they've got 3 kids, or that they're just starting a family over the next couple of years and they're getting 1, 2, or 3, that they want a lot more buffers in their borrowing power. Because if you start trusts earlier, 1 or 2 properties earlier, you're pretty much protecting your borrowing power in doing that. All right, so that's just a couple of concepts that we need to talk about regarding that. Then we talk about the cash flow component. All right, so when you're doing these kind of projections, and this is going to link up to the last point there, cash flow is money that's coming in, right? And you need to be realistic on what the costs are involved with holding, one property compared to 10. Because if I hold 10 and, one property goes off or has a vacancy, it doesn't hit you too hard, right? Or if I've got 1 property but 2 rents on every property with a granny flat, then I'm even more protected from a cash flow standpoint. And also you got to manage that cash flow while you go through a ramp phase where you're going through a buy cycle, right? A lot of people think that the money is there, it's available in their account, but then, they started a business, so they haven't accounted for their GST that they've got to pay, or their quarterly BAS, or they've got a amount owing to the tax office, or they haven't accounted for 3 to 5 grand to leave on the side for maintenance and vacancy on their properties. Or one of the properties has an insurance claim where you can't rent it out and you're having a shortfall. So these kind of things, you've got to look at your cash flow, but also you've got to manage your projections. So a lot of these people, when rates were 2 and 3%, were running their projections at 4%. Okay, and you see these buyers agents as well when they're running their economic growth and their growth modelling, and they say, oh yeah, the last 10 years, Eastern Suburbs has done 7 to 8% in the last year for 10 years, but you average it out over 30 years and it's slightly lower, and then if you went back another 30 years, it's slightly lower again. I never use 7 or 8%. I use 5%, and I've always used that, regardless of if I buy in a city or regional. Okay, I just use lower amounts when I'm lower percentages when I'm doing my projections. For rent, I use 3%, even though the last 2.5 years, some of these rents have gone up 20, 30, 35%. Okay, I don't, that's not in my projections. That's not in what I use. I use 3%, because on average over a 30-year period, 3% is a good amount. Okay, then we talk about interest rates. So when we're looking at cash flow modeling and things like that, one, you've got to be true about the costs associated with holding these properties. And there are ways to manage the costs. Like, I'll give you an example. Your insurance, at the start, when you've got 1 property, you're probably going to pay like a 1 or 2 grand excess. Okay, so an excess is when you make a claim, you've got to pay that excess, and then you get the claim as long as your insurance company approved your claim, right? Mine, across all of my portfolio, is 5 grand. So I reduce my insurance costs by about 30 to 35% because I do that, and I know that I only want to access insurance if it's a large claim, because I'm sitting on 9, or I've signed a contract for my 9th one. So I'm sitting on 9 investment properties with a lot of granny flats on the back. I'm sitting on 8+% gross yields on contract price and much higher gross yields on debt. Okay, so from my point of view, if there's a shortfall and it's only a small amount, insurance claim, maintenance, things like that, I would rather just pay it out of my pocket than pay it through the insurance. So once you multiply that through multiple properties, and you've got 8, 9, or 10, and you make sure you're checking this with your insurance broker, I'm saving a lot on my insurance just by doing it that way. And I think overall, that's just one way that I can manage my cash flow a little bit better. All right, so that's just another thing to think on. Now, interest rates. When rates were low, everyone was, like, even the conservative ones were running interest rates at 4%. I never did it. I ran it at 5%, and even I was low. okay, you always have to assume that rates are going to come back to some form of medium or average, right? Because if you're not doing it that way, you're not being conservative. If it doesn't work at those numbers and you're not comfortable with how the modeling works at those numbers, you shouldn't be buying, or you should be running a different kind of strategy. So again, you've got to be putting buffers on these projections so that you fully understand what's going to happen during a stress moment, what's going to happen during a market downturn, what's going to happen when the market goes against you. Okay, and that's why I'm sitting here and my wife's sitting here and she's turning on the news and interest rates this and property crash that, and all she does is giggle. Okay, we're very low stress on our side of things, holding a large portfolio that's ramped very quickly because we're being conservative with our numbers. All right, so let's talk about buffers in structures like trusts or SPVs, so specialized vehicles. And we've already talked about these concepts already when we talked about the borrowing power point above. So you've got to protect your borrowing power. And normally what happens is, and what happened with me was, and I was a little bit different than most. So I knew of these structures. I didn't have the right accountant, but I knew of the structures. But my goal was to maximize what I could do under my personal names while the rates were low. So I managed to get 7 out of the 8 properties done before the first rate increase, or right on the edge of the first one. And then my 8th one got done right when it was like the 2nd or the 3rd or the 4th increase during the time that the settlement was going through. All right, so if I did corporate trust during that time, I still could have bought a lot of property, but I definitely couldn't have gone as fast as I did, because I bought one property and then I had almost a year gap, and then I bought 7 in about like 10 or 11 months. So there's no way that I could have gotten the asset base that I did if I went down the structures route. And I always knew that I had the ability to cut 1 or 2 properties that I made the most money on, sell it, get the CGT, and then pay the CGT, the capital gains tax, and then recycle that back into 2 new buyers, using trusts. So that was one option. Or potentially moving 1 or 2 of the properties out of my personal name into trusts, paying stamp duty again, and then the CGT on the new valuation. And then you're in a situation where you've now protected your borrowing power, and I've got buffers, and those 2 properties get removed from the borrowing power calculator going forward. As long as you're using the right accountant who's willing to sign off to say that each trust is profitable, and then we go ahead and use a lender that excludes corporate trust debt. All right, so that's just something to think about there. So buffers in structures like trusts and specialized vehicles, and making sure that we're talking about what the future looks like, what your goals are, and then we talk in those kinds of concepts. Then we talk about our deposits, right? A lot of people don't factor in your stamp duty, your solicitor cost, your moving cost, your loan cost. Okay, if you're using a buyer's agent, you've got to add that in. Okay, and most of the time, if you're doing like quite a few properties, as soon as you get past about 3 on LMI, you start having problems. So you do your 10% deposits, which is great, but I think out of the 8 properties that I bought, 3 were LMI declines, or they weren't full declines because I was dealing with a banker that could check. But at the end of the day, the LMI provider didn't want it and forced me to do 20% deposits. So if you're going through a big buying sequence and you don't have buffers with your deposits and your cash, plus the ability to still proceed if there's a 20% deposit requirement, and you roll with the punches to get the deal, and obviously it's a lower risk deal. If you're doing 20%, you're getting a better interest rate, your cash flow is better, your rent on debt is better, everything's better, okay, but you've got less money, right? And if you're going through quite a quick buying sequence, then you've got to make sure that you're modeling out what your deposits look like, how much you need, and where your buffers are. Okay, and the bigger your portfolio gets, the more buffers you need. Like right now, me going on my 9th and 10th investment property, that's pretty much it. I'll probably stay minimum 2 to 300 grand in cash going forward. So pretty much short of a house being burnt down and not having an insurance company cover me, every other kind of example is covered for. Oh, and I'm never going to go onto that. And lifestyle wise, stress wise, family wise, the bigger your portfolio gets, the more money you need to park on the sidelines as you go through. So then it just doesn't hit you from a stress component. All right. Now, we've already gone from deposits, and then we've gone through and talked about cash during a ramp phase. And then because we've already talked about projections, let's just talk about marriage and relationships. Okay, you can have all these skills and experience in the world, but if you don't have a partner that's comfortable, you are never going to get to your end goal, especially if it's a big goal. Okay, so how I did things with Maria, who was very supportive throughout this journey, was I told her pretty much where we wanted to be, and I explained how, and then I gave her 2, 3, or 4 different examples on ways that we could do it. Asked her if she was comfortable inside of main cities or if she was comfortable in large regional, or when and how. And how, the good thing about our first one was she got that one done, and then there was a 12-month break, got the second one done, and then we both had 2 good deals done. We made some money. Maria got comfortable, and then she's like, unleash the beast. And then she just let me go. Okay, so you got to make sure that 1, they're understanding on what the total process is. 2, the stress that it's going to put on the family and how you're managing that. 3, the different forms of way of getting to the goal and talking about it with your partner. And then also talking about the timelines that you want to get there. How much do you want to delay the gratification to get to where you want? Okay, and just talk that immediately you're not going to have immediate success. It's you can do your income replacement way like I've done. So within 3 to 4 years, you could be close to fully income replaced. But those 3 to 4 years, you're not upgrading the cars. You're staying in a rental. You're not having any credit cards, personal loans, car loans. No HEX debt. Okay, we still, we'd still go out to restaurants, but we'd only pay $50, $60. Then we go on a Sunday afternoon where you get happy hour with the beers. And Maria and I were happy during all this time. We can honestly say we're not too stressed during this buying sequence, but there's a lot of people, lifestyle-wise, that wouldn't be able to do what we've done. Okay, so you got to think about it from that. There's a lot of marriage breakdown and stress related to money. Okay, so you got to act as a unit, building it together, because if you have 2 people pulling in 2 different directions, you are never going to get to your end goal. So talking about that, buffers in strategy, buffers with how you speak with each other, and you need to know how conservative the most conservative one in the relationship is, and then let them set the strategy and the timeline, so then you know that they're happy to continually sign off and get you to your end goals, and everyone's on the same team playing in the same direction. Hope that this video has added a lot of value. Please book an appointment with me below. If you've there's a link there that in the comments where you can book an appointment directly into my calendar. We help a lot of property investors get to income replacement. All right, we can help you on the buyer's agency side as well if you need, or we can just help you from the finance side. It's completely fine. All right, I hope that this is giving you a lot of value, and that this answers the question that my client had this week on buffers and talking about some concepts. And we'll see you on the next video. Hit the like button, hit the subscribe button, and leave me a comment if you're liking this kind of content. All right, we'll see you on the next one. All right, then, bye.